I should begin by saying that this paper has been in the making, and it is likely that it will continue to be in the making until I die. But I think the problem with this paper is my general conversation and dissatisfaction with many of my colleagues and Keynesian and Kaleckian economists that we have a framework of, from the time of Keynes's general theory certainly, or even earlier treaties, about how to deal to some extent with money. But the nature of money has changed over the years. In capitalism, we all know in a certain way finance has become important and so on. But I do not see sufficiently integrated approach where you can really see how money matters, unlike in the earlier cases of general theory and so on. The paper started from this, and the first paper which I wrote with two other colleagues was published in 2006, when still the crisis was on. And it was basically based on what, if you have capital gains and so on, what happens to the economy. And it was a theory of the relation between the virtual and the real economy. And the paper was published in Macroeconomica and another in the Cambridge Journal. But they were just, and I have been going on, but I know I have not got really at the substance of the thing. So this has been going on for about, at least from, distinctly in my mind, from 2006. And even earlier I had been, when we were doing the profit-led, wage-led and so on, I was aware of the weakness of that, or the incompleteness of that kind of approach. What I want to do is, I made the mistake of trying to explain the equations last time, which I will not do this here in the short time. I'll just tell you where I start and what I'm trying to get at. You see, from the time of, let us say, from the time of Newton, it has been the general idea that small causes lead to small effects. And this was a grand success in terms of classical physics, classical mechanics. At the same time, with Newton, there was Leibniz. They were more or less contemporaries. And Leibniz was a philosopher. He was not a physicist in the sense of Newton. But he had this question, which all the time he and the people around him were asking, that is it necessarily true that small cause leads to small effect? And later it was picked up by this common saying that how many straws can you put on the back of a camel? And later it became self-organization and so on. When is it that you have a critical point, or a critical point in the organization, or a critical point in something where suddenly the thing collapses? That thing collapse in the physical world was very clear. Earthquakes, volcanoes, tsunamis, you name it. There are so many events which are really not part of classical physics. And there are, in most cases, there are no explanations of that even today. I mean, formal. And in economics, probably the most prominent example of this is collapse, which happened in 2007, and not for the first time. If you read economic history, this is something which in different ways has happened earlier in many ways. So I was trying to see, this is how it started, that is there any way in which the Keynesian or the Keynes-Kalecki kind of framework can be extended so that actually in a formal way, we can capture this kind of sudden collapse from small changes. That is, you assume that small changes are going on, small increase in, whatever it is. You are making small capital gains, stock market is increasing at a gradual rate and so on, and suddenly things come down. There was a kind of formalism around it, which I learned gradually, which was the French mathematician René Thom's catastrophe theory. You can use it, later I realized you can probably do it much more easily, but that is how I actually first started on the problem. Today I want to tell you about the process by which I think you can get there. Whether I have got there or not, I still have some doubts, but I think in a broad sense we are we are on the track about how actually formally to say 10 years after the crisis, what is the mechanism, at least what is one of the mechanisms by which the crisis happens. And if this is true, then something like a multiplier, something like that sort, we would be able to say what magnifies the whole thing and how it can be done. Now, for this, let me start from, you see, we set up a model. I would not go into this. This is where all this huge number of variables and equations look like. I start by setting up a model, which is the simplest one I could think of to capture the whole thing, which is it has a real sector. The real sector produces a consumption good and an investment good. And it has a financial sector, which produces the usual banking, including the central bank, which has the usual liability, the usual notion of money and so on, and a whole penumbra or a whole surrounding it, a whole what you call a shadow banking sector, which creates credit, but which is not supervised, around which there is nothing, and which is very much a part of the modern capitalism now. That very many kinds of institutions exist at different levels, which have this thing. So you have, in that sense, you have a real sector producing real commodities, and you have a financial sector producing financial commodities. Now, both these sectors have ability to invest. Now, this I have to say something, and this is what the real sector means in terms of investment expenditure on the real sector is relatively clear. For the financial sector, the mental picture which I have, for which the model works, I'm sure the model works, but I do not know whether that mental picture is totally correct. For the financial sector, it produces financial goods. What does it mean? It means what basically, I think the first person to emphasize its importance was modern securitization. That is, you combine a whole set of different debt obligations or set of, collateralized assets and so on and so forth, but different with different time profiles. And you offer new papers, you offer new financial instruments in terms of which you can say that it will suit, if you buy it, it will suit your stream, either in terms of interest income, in terms of rate of return which you get on the paper, or in terms of when you will get it, in terms of timing and so on. It is what in neoclassical economics you will call smoothing out the consumption stream. That is one of the main functions which is performed by this kind of securitization. Now, taking this mental picture of a real sector and a financial sector which produces financial instruments, I see, and I make the simplification, which can be very easily done away with, which is there in the standard, Kaleckian models and so on, that wages are all consumed away and only a part of profit is saved. And the profit now comes in two forms. The profit comes on the profit which you make on the selling of the securities, the securitized financial assets, and the profit which comes on the usual markup on the real sector, which is there in Kalecki and so on and so forth. And this is where you get two sets of equations. I want to stay away from the algebra in 25 minutes. You get two sets of, you get a set of equations which are flow consistent, which is basically saving investment equality in the general case, and you get a stock consistent equation, but which has to be sufficiently simple, unlike the work of Godley, Lavoie, and so on, where I started from by looking at in 2006. I'll look at it again, where basically you get much more complicated accounting equations and so on. I wanted to get it in a form where you could look at it. And this is the trick which I use. I'll tell you, it is a trick which I use, that you have a book value of capital, or what, if you like, it is the usual accountant's value of capital in terms of the future income stream which it earns on the assumption of a perfect foresight. If the foresight goes long, it is not right. But there is a book value of capital, but for distribution, that is for the stock market, how the profit will be distributed. You have all these financial instruments and all these financial details in terms of which there is a distributional value of capital. The two are not the same. I mean, obviously, we all know that the stock market value is not the same as what the accountant does as the book value of a firm. Now, I take the ratio of the two, which I call, that is, which will be, you see, there is a book value of capital, which is at the level of the firm for producing capital, goods, real goods and assets, then which is placed in the stock market. And then there is a stock value of capital, which is for the profit which is earned on which various instruments are added and for smoothing out the consumption stream. And those who own, this is the ownership value of capital, and it is distributed to various people and so on. I call this wealth. The value of wealth as opposed to the value of capital which is used by the firms. So if you divide the value of wealth by the value of capital, you get what is more or less the average value of share prices, stock prices. More or less, this is the framework which I use. Now, using this framework, what I get is two things. One is, now how do I operate this? This one? Oh, okay, I know this. What I get is something. What I get is something quite simple, that is, well, that is, thank you. What I get is something very simple, that is, I have a flow equilibrium condition, which is the saving equal to investment, and I have a stock equilibrium condition, which is that the value of capital for distributional purposes as valued by the capital market, or if you like, simply the stock price, to the the value of capital as valued by the firm. That ratio must not change. These two stock value must also remain constant for a full stock flow consistent equilibrium. I mean, in a simple macroeconomic model, cutting out all the accounting identity, this is what I'm trying to get at. Now, if you only take the stock value, actually you get a whole simple way of doing the whole of what is called standard growth theory, but with now finance introduced in a big way. That is, if you look at the flow equilibrium and the stock equilibrium, the two are combined in terms of what is shown as equation 7. V is this ratio, the average value of stock price, and this depends on the growth minus how much of that growth is realized in the real sector, because it may not be, the full growth may not be realized. I would not go into the reason unless you ask me. And on the below, it is the other way around. That is, the top shows the excess demand per unit of capital, unit of real accountant's value of capital, excess demand in the real sector, and the below shows the excess supply or excess savings. This is excess demand, and the below is the excess savings of the financial sector. This balance is what the algebra gives me as the value of V, the stock price. This is what I get by using the stock flow consistent equation. Now, then equation 8, which is simply the stock equilibrium condition, which is that V must not change. The value of the two capital stocks must be in equilibrium. That is, the two growth rates must be in equilibrium. The value of the rate of value at which wealth is growing and the value at which the real capital stock is growing. Using this 7 and 8 and doing a little bit of manipulation, I get what you would call a pure stock equilibrium model, assuming the flow is constant. This is exactly the same kind of assumption which you have in neoclassical growth theory, but of course in a different context. That is, you have a kind of parabola. There is a mistake here. It should be V square. You have a parabola here. And the right hand the cutting point is stable. One diagram, phase diagram, the right hand point is stable. The left hand is unstable because it's rising here, it's falling here. That is, we need not spend our time. But the important point here is that just like you have in, let us say, in Solo's model or Swan's model and later all neoclassical models, it is a stock equilibrium model. The ratio of capital stock to labor, both of which are stocks, they adjust to a certain level at which they both grow at the same rate and so on. You are getting a similar story here in terms of, the growth equilibrium, but only assuming that the flows, the saving investment equality is being maintained. It doesn't move after this. Maybe it's an indication I should stop.
You can also use the arrows here.
Okay.
Okay.
Well, anyway, then I take the saving investment equilibrium, which is the kind of Keynesian growth models or Keynesian way of looking at it. I introduce independent investment functions. Taletsky's, Keynes's, whatever it is. I make both savings and investment, not investment, investment to be functions of the rates of profit of the two sectors, and the two types of growth rate, both are affected by the profit rate of the other sector. And using this stock flow consistent model, I get usual comparative statics, equilibriums, and so on, which shows that if both the stock and the flow equilibrium are maintained, for example, in this diagram, that rho is what would be the rate of return on stock, and R would be what would be the rate of return on flow, and you would be able to define a whole set of equilibrium, the comparative statics of if what savings changes, if stock value changes, and so on. I did not go into all this. Now, when the interesting point comes, this is all sort of in terms of setting up the stage, because I'm basically interested in showing when the camel's back is broken, when suddenly you have a collapse of the economy. Can it happen with all this simple difference, almost textbook, calculus and so on? It can happen, and that is the interesting point. This can only happen when you put the stocks and the flows together. And I think if I'm correct, this is something quite unusual. A stock flow consistent model can also give you a sudden collapse, which is of a different kind, and that is the message first message which I would try to establish formally, mathematically. And that stock flow consistent model, where saving investment adjust with investment as an exogenous investment functions introduced, and the stocks with share price or stock price moving in terms of the model. When you combine both of them, and that is where the algebra gets more and more, but I will not show the algebra. The algebra gets more and more awkward. You get you begin to see that you can get situations where you have two, in between these are imaginary values, you can get two values of shares, very different, with M. I will explain in a minute. This is really what I'm getting at. What actually drives the model is neither saving investment equality, unlike in standard model. The mechanism is something which with Joseph Steindl, many, many years ago, we had discussed when monetarism arose. I was telling you yesterday. When monetarism arose, and I came back to it when after doing all this algebra, when it suddenly looked like that is the way the thing probably will work. That is, you see, what happens is once you introduce a value of capital which is at the level of the firm and at the level of production, that what is the value of this capital at the level of the accountant, with all the capital theory problem at the moment set. And once you look at the value of capital as wealth, in terms of how people own these assets. And when you look at the two together, the profit of the economy is getting distributed between the real sector and the financial sector. There are two rates of return, as you can see in all the cases, and there is a distribution of profit between the two sectors, which I call M. Now, the rates of return and the you see, yeah, I think if you look at the rates of return and these are the equations and so on. Yeah, if you look at this, very simple. If you look at 31, it actually shows the share of profit in the two sectors and how it is related to share price and the share of the rate of return. That is X, which is rho by R, and also the other. You combine these two, you just take the multiplication of these two, and you get the share of profit. Now, what happens is, if you do manipulation and so on, it is a bit like Marshall-Lerner condition in international trade. If you manipulate a little bit these equations, you will see something very simple. Because you see, it is possible that the share price, you will see that the share price rises, and if at the same time the rate of return, the relative rate of return of the two sectors also rise, M must rise. But it's not necessarily that must happen. It is, for example, it is possible that the share rises, the share of profit, distribution of profit between the two sectors rises. This rises much more, this falls. It all depends on what is the, how are they related in terms of, you can have, and capital gains and so on would come in here. And let's keep the story simple. M is a product of these two, and one might rise, another might fall, but depends on the relative rise and fall. Now, if you take this framework, and if you now vary M, you get these, for certain parameter values, analytically speaking, I mean, I don't mean in terms of simulation, you get a situation where this shows, I'll end here, this shows how the share price will move with suitable transformation of variables and so on, because it is actually suppressing certain, on a light surface or on a flexible surface, it is suppressing the topology of it. You look at it, what you get is a cubic equation in M, with M here, and it moves like this, and there is a constant term, which is actually the constraint of how the share price has moved, which is here. And when you convert it back into the original share price, and simplest way is you rotate the diagram clockwise by 90 degrees. And also that variable changes, there is a translation of the variable, it shifts. You get a diagram like this. That is, you have a whole set of points which is stable here, stable equilibrium points, stable share prices. You get a whole set of stable share prices here. You cannot say how long the economy will, I mean, at least from this model, you cannot say how long the economy will be on a high or on a low capital market performance. But in the whole in-between range, you have a sudden drop. And that is what I'm looking at. You will get an abrupt drop in the system. And this comes simply from putting the stocks and the flows together. Thank you. If I'm right, then it has two messages in terms of policies. I think, if I was talking about policy, it's probably a bit too early before, but it has two messages which are important. First one, I mean, lots of statistics are calculated, but very, very seldom you see statistics available on how profit is distributed between the financial profit and profit from production. This is what is critical for an early warning system. The second thing which is, if you see that the share of profit is moving in favor of, let us say, the financial sector, for whatever reason, capital gains, whatever reason, the share of profit is moving in favor of the financial sector. But share prices are falling because you know it is a product term, as I said, and it can happen. Share prices are falling. You know you are close to you might be close to a abrupt change, a catastrophe. So actually what I'm looking for is what, mathematical ecologists and so on look for, an early warning system which will tell you when very large financial, very large financial collapse can take place, and an actual characterization of it in terms of a formal reasoning. Thank you.